Hello and welcome to this week's economic update. My name is Lindy Pond, and every week I share some information with my group of investors so we can all stay informed and educated about the decisions that we're making. So let's go ahead and get started with home price appreciation, which does not include jumbo or cash buyers, reported that home price appreciation rose 0.6% in September, which is up 6.1% year over year. Case-Shiller, which is a private report versus FHFA is the government report. Case-Shiller says that home prices rose 0.7% in September, so very close, right? Up 3.9% year over year, slightly different. They say that we are on pace to reach 6% by the end of the year, which then would be in line with the FHFA. The increase was widespread across the U.S. The GDP, or gross domestic product, value of all the final goods and services produced in a single country during a specific time period, usually a year. We measure this here in quarter one, quarter two, Q1, Q2. GDP is used throughout the world as the main measure of output and economic activity. So it is a very important reading. So the 2023 Q3 reading, which is the second reading, said that GDP increased an annual rate of 5.2%, which was slightly higher than the expected 5%. This is up from 2.1% in Q2. The increase in Q3 primarily reflected increases in consumer spending and inventory investment. This is not expected to repeat itself in Q4. In fact, Q4 could be quite different. Personal consumption expenditure, or the PCE, which is the Fed's favorite measure of inflation, reflects changes in the prices of goods and services produced or purchased by consumers in the U.S. So the total PCE from September to October was flat, but declining inflation year over year from 3.4 to 3%. So absolutely in the right direction, right? This was in line with expectations. The core PCE, which removes energy, rose 0.2%, which was in line with expectations. And then the personal income. So this report talks about both expenditures and income. Personal income rose 0.2% in October, also in line with expectations. Spending, on the other hand, rose 0.7%, which was above the expected 0.5%, and savings rose only 0.2%, which was a big decline from September's 0.7%. The savings rate is still the lowest since 2008. So as you can see, we are spending more, we are making a little bit less, and definitely saving less. Heard on the streets for the week, Apartment List reports new rents fell 0.9% in November, resulting in a decrease of 1.1% year over year. The market projects the Fed will not begin cutting rates until mid-2024. May, June was what I read in a couple places. CoreLogic reports that loan performance worsened slightly in September, but remains at historic lows. For example, the 30-day or more delinquent is still only 2.8% of all mortgages. I think we're at a 40-year historic low. When it comes to home buying decisions, 19% of all home buyers factored in their pet into their neighborhood choices, according to the National Association of Realtors. Our weekly conventional mortgage rates for owner-occupants are improving. It looks like we definitely have hit our peak and we're coming on down. So last week we were at 7.37 and this week we are at 7.17. Investor DSCR rates are starting to improve slightly. Could have just been a fluke last week. So they're still somewhere between 8 to 11%. I'm seeing some high sevens, but that's with some points. So again, I would say 8 to 11%. If there's anything I can do to help you with your investor financing needs, you please just give me a call or shoot me an email. Thank you.